The Bank of America Institute releasing its December consumer checkpoint. That is a real-time estimate of spending. And joining us right now to break it down is Liz Everett Krisberg. She is the head of the Bank of America Institute. And Liz, when you joined us about November's numbers, it was a little concerning because those numbers were flat. What did you see in December?
It was a little chilly in November, but the December numbers and the December data prove that we ended the year with a rebound. So we wrapped up with a rebound there. From a year-over-year credit card spending, we were up 1.8%, bouncing up from 1.3. Month-over-month, seasonally adjusted, up 0.5% relative to 0.2. So you're seeing a rebound there. You're also seeing a rebound. I know you're going to be spending a lot of time talking about the jobs report. Our data also shows a rebound in payrolls. So we're also seeing, and we could talk more about either one of these, but what I would say in general is that after a very chilly November, the consumer has not run out of gas.
Does that tell you that people will always spend at the holiday, or does that tell you that there's a real turn? Just seasonally adjusted numbers on this, if you go back and look, how important is this?
So seasonally adjusted, and I misspoke there, so let me correct myself. Seasonally adjusted month over month, we were up 0.5% relative to flat in November.
Okay. I thought it was flat.
Yes, it was, and I was confusing something. But prior to that, you'd had 5 months of consecutive growth, seasonally adjusted month over month, right? So what that kind of tells you, and then when you look at the numbers and the spending on holiday in particular, it started off really strong and started early in October, but then lost momentum into Thanksgiving.
So
on holiday spending. And this is what we've got a series that looks at things that are generally.
So you don't think this was holiday spending? You think this was generalized consumer spending?
It was both general and holiday. And we saw it then rebound in December. So it was a combination of both. But what was interesting was, and the question I think you might ask is this just because prices are going up? You know, are people buying more? And what we saw was a behavioral shift in the consumer in that people, it wasn't just prices that was causing the spending to go up. It was actually volume. It was actually transactions. But people were focusing on smaller ticket items, so general merchandise, clothing. That was the beneficiary. The big ticket splurges, the durables, the furniture, the electronics, the travel, that pulled back. So you're seeing the consumer adapt, and I think that's kind of the word of the year for going into 2026 is adapting. The consumer's adapting.
Well, that makes a big difference into who will be winners and losers in the retail sector, too, if it's clothing and small items and not those big durable items.
Certainly, and also relative to what the consumer is buying. You know, our company's going to think about, let me get the right price point out for what the consumer is looking for. That being said, you know, when we talk about the consumer, we always talk about it in general, but there's different characteristics, right? The higher income consumer continues to be spending and growing their spending at a much faster pace than the lower income consumer, right? Up 2.4% relative to 0.4% for the lower consumer. So that gap continues. But one thing that I would say, and we talked a little bit about this last month, we use the phrase K-shaped recovery, but that isn't the right terminology necessarily because it implies that one is going up while the other is going down. And that 2 percentage points gap between higher and lower income has been consistent really for the last 6 months.
So it's more of like an alligator mouth.
Well, you know, amazingly, that hasn't caught on yet. You know, you brought
I said the same thing last month.
You did, and people aren't using it.
And I didn't realize I said it last month until just now.
So we've got to focus on that. You know, we got to get that out there. But I don't even know an alligator mouth because then the higher is still accelerating. In this case, we're moving them in a parallel. So I'll work on this for next month. I'll come up with a better analogy.
You said something about payrolls, that payrolls actually picked up, meaning what?
So what we look at our data is the number of households that are receiving a paycheck and what's the growth in terms of that number of households. And in December, we saw that increase up 0.6 relative to 0.2 in November. So more people are getting
you think that'll show up in the jobs numbers that we get tomorrow?
Well, I hope we get them today.
I hope we get them today.
Oh, today's Friday.
Today's Friday.
I hope we get them today. But
I'm not coming in tomorrow.
I think generally this has been a good indicator. One of the other things that we look at in our data, though, is the number of households that are receiving unemployment income. And here what the data is showing us is that the pace of growth there is up about 10%, has been relatively consistent and relatively steady over the last 3 months. So we're not seeing an acceleration in the number of fires, and we're seeing an increase, but not a rapid increase in the number of people getting hired. So it really, if you talk about a term that does make sense, that does work, low hire, low fire environment is what we're seeing in the labor market.
Okay.